Hello and welcome. You're watching KYC. It's a show designed to give you powerful, actionable insights into a single listed company daily. And today we're going to talk about Insecticides India. Interesting company per se. It's in the agrochemicals and biological and household products. More into crop protection and nutrition based in that sense with regard to what the company does. It has a portfolio of 20 plus technical products and 125 formulation products. Largely products are surrounding insecticides, herbicides, fungicides and biological products. So those are the four broad based categories of the products that the company does. In terms of domestic, a large part of the sale comes, or rather the large part of the revenue comes from domestic, but it exports to 30 countries with more than 100 customers and also commands a decent amount of an export base in that sense because of the number of customers they have. In terms of revenue mix, and this is where it's interesting because you'll see the skew in revenue being very sharp towards insecticides and herbicides. Combined commands 87% of the company's revenue. So look at insecticides is 48%, herbicides is 39%, and then fungicides and biologicals are just about 10 and 3%, so 13% in all. The one big thing that has happened, especially when it comes to an Insecticides India, again a very interesting piece here, that they've moved towards premium products. So their premiumization trend from FY21 to FY24 in the 3 financial years has gone from 46% to 59% in terms of premiumization of product. So therefore generics now starts to command a lower share. This particular trend may likely continue even going forward. The question is, what is the impact of this trend on the P&L? And we'll analyze that when the income statement comes up within our metrics. But essentially, this is something that you may want to keep in mind. The other thing is, how is it playing out segment-wise? So B2C, which was 65% in FY22, is currently at 82%. B2B, which was 26% in FY22, is currently 11%, and exports is still roughly single digit. So that's the segment-wise breakdown. Again, why is this relevant? B2C will always command a better amount of margin and therefore is more favorable to an Insecticides India. Can they continue to make that journey? How much can they continue to do that is really the interesting question, and we'll speak with management to try and get a perspective at the end of everything that we are going to speak about ourselves. We'll speak with Rajesh Agarwal, who's the Managing Director at Insecticides India, to also dive deeper and understand this better on what he believes the journey of the company will likely be. But let's talk about metrics as we always do. We'll start off with the income statement and thereafter the balance sheet, the cash flow and the return ratios. We'll keep those common on most companies. So that's how the parameters will stack up. Thereafter, we look at shareholding, street cred, valuation and outlook and risks. We'll also look at the risks to the outlook. That will be important to understand. And we'll give ratings on each of the parameters. But Varsha Chandani joining me today morning to try and help dissect this company further. Varsha, income statement with regard, first off, Insecticides India, do you have maybe a thought or two with regard to the business itself?
Yeah. So, Harsh, every company has a next leg of growth, right?
Sure.
For insecticides, it is the next leg of growth for this company is, the premium products that they are trying to cater to, higher margin products, value-added products, which will actually help build up their margin. So this is basically the next leg of growth, and for that they're also doing capex, which will actually speak when we will address the outlook and of course the capacity expansion that the company is going through. But let me just go to income statement. Now if you see, for the last 3 years the revenue CAGR for this company has been like 11%. But if you see in 2023, so in 2022, the revenue for the company was around 1,504 crores, which jumped up, and in 23, it did jump off with at 1,801 crore. And the reason why you're seeing a huge spike in FY23 was because of the capacity expansion that the company did and the new product launches that the company had come up with in 23. However, if you see the margins for the company, margins declined to single digits. Now this is due to, so there you go, from 11% in 23, the margins came up to almost 7%. Now this is due to higher input cost that the company was facing and also the higher inventory liquidation. So what exactly happened, if you see, there was a pricing pressure in the industry. There's still pricing pressure in the industry, and a lot of agrochemical and chemical sector which has gone through, and you're seeing the financials for the company has been very, very weak because of the pricing pressure that the overall segment is going through. So for insecticides, you had this inventory in the balance sheet which was sitting at a very high price, and because of the agrochemical pressure, the chemical pressure that the industry was seeing in, the end product prices were very low, which actually impacted your sales and which actually impacted your margins, because you were buying at a very high price, the raw material you bought at a very high price, and the end product you were selling at a very low price, which actually impacted your margins. And that's why we are seeing the margins at almost 6.3, 6.8 or 7%. Now, so overall, you see, Harsh, the growth for this company has been slow, like 11% CAGR. Of course, because of the industry dynamics, the pressure in the agrochemical sector. But the one thing which we should actually ask the management, because we have seen that you were talking about, the increasing premiumization, but that has not led to increase in margins. That's the one question, that we should be asking to management.
Yeah, so we'll contextualize that, and thank you so much for giving that perspective as well, Varsha, that margins haven't bounced back despite that premiumization. Something to be kept in mind. Let's look at the balance sheet now. Shareholders' equity plus reserves would roughly be 1100 crore. It's a 2000 crore market cap company, so trading at 2x price to book. You're looking at long-term borrowing, which is probably less than 65 crore. And or rather long-term plus short-term less than 65 crore, and therefore the cash surplus that the company actually has is more than both the long-term as well as the short-term borrowings, which kind of nullifies any major risk that could affect this company. Plus, on top of it, have to keep in mind that the market capitalization of the company is 30x of the cumulative borrowing, and the EBITDA number, annualized EBITDA number, is nearly 2.5 to 3x that of the borrowing number, and therefore enough margin of safety, enough comfort with regard to how balance sheet strength looks. Capital allocation seems to be happening okay and largely from retained earnings, and no borrowings are currently being used. Efficiency of that we will leave to the viewer because it's a cyclical business, and therefore something to be kept in mind that large borrowings on the balance sheet of companies like this can well impact the numbers, especially profitability, in years in which there is a bit of a slowdown, which it has experienced in FY22, in FY23, and to a certain extent in FY24. Am I right, Varsha, when we look at it this way, that generally a larger debt on companies like this especially can pose a very large risk because it's a cyclical business?
Exactly. And so the good thing is that, as you mentioned, the debt to equity ratio for this company is really low.
Yes.
So that is the advantage that the company has got, considering the pricing pressure that the segment is going through.
Fair point. What about cash flow, Varsha? How is that evolving?
So I would say it aligns with the income statement, first of all. And the other thing is, if you see, if I strictly speak for FY24, the cash flow from operation was around 184 crore, while the net cash flow is 43 crore. Now, if you see in FY23, cash flow from operation was negative 11 crore. Now, one of the reasons is because the company was sitting at a huge inventory. Your cash was stuck in inventory, and that's the reason you're seeing this negative cash flow from operation. And the net cash flow, of course, was negative 17 crore. But overall, if you see, because in FY23, as we spoke, that the company had a huge growth because it did a lot of capacity expansion, was going into a lot of capacity expansions, and also, and this is the reason you are seeing, you know, one is inventory. You were sitting at a very high inventory, then capacity expansion was going on. So that 1 year was very negative when it comes to, you know, cash flow perspective. But in FY24, if you see a good cash flow from operation at 184 crore, and you know, finally net cash flow at 43 crore. So we would give a kind of neutral rating for this segment.
Point taken. What I'm not liking though, Varsha, is the return ratios. And I've given this a thumbs down from a perspective that when we're looking at how the return ratios are playing out, we're seeing the ROC numbers at roughly 14 to 16% in FY21 and 22. Thereafter, we've seen a blip, and we've seen them remain there. So it's been anything between 9 to 13% on the ROC metric. The ROE numbers look even weaker in that sense. You're seeing around 7 to 11% ROE with FY21 and 22 looking not even at teens in terms of the ROE number. What you would want from a company which is small is to be high ROC, because you want it to grow quickly at a very, very good return to equity and return on capital employed. That is not reflecting fully at this point on an Insecticides India. To a certain extent because of the industry in which it operates in, to a certain extent also because of some headwinds that have come through. The question will be that can they hit at least a basic early teens kind of ROE number? That will really be the question. So for now, we're going to give this a thumbs down because it continues to invest capital of shareholders back into the business, right, Varsha? Yes. It invests straight back into the business, doesn't use debt to invest in the business, and therefore you want it to get better return on equity for shareholders. If it's not doing that, it may not be the ideal business to invest in, you know, unless Harsh, it's at the right valuation.
On that point, I think in FY25 also you would see some kind of compressed return ratios because they are going for the capacity expansion. So again, high denominator and lower numerator. Yeah.
Perfect. So there'll be a pullback there. But yes. Varsha's shareholding.
So we would give a thumbs up on that matter, because promoter, now skin in the game, that's very important when it comes to any company. 72% stake by promoters, which is very good. FIIs at 4.5%, though they have decreased their stake, but still okay. But what interesting here is DIIs, which has almost 9.5% stake. Now, from this, almost HDFC small cap has 9% of stake in this company, while, you know, public has almost 14% of stake in this company. So good skin, good promoter holding, and of course followed by DIIs and FIIs.
Yes, interesting one, that one. Let's look at street cred as to how the stock has done. You know, over the last month or so, while the stock has done fairly well for itself, markets have been buoyant as well. When we're looking at the year-to-date data as well as the data when on the, there you go, that's the 1 year performance, which is roughly 12% odd. You're looking at a return ratio which is slightly on the muted side, even when we're looking at the 5 year performance, just about a 2-bagger. So overall, we're giving this a neutral because of the way in which the stock has moved. Last 6 months has been difficult. Last 12 months, not as bad, essentially. It's done fairly well for itself. And the last month or so and year-to-date also, month or so has done well, but year-to-date has been muted. That's how it's played out on this one. We'll give it a neutral. But Varsha, on the valuation picture.
So, you know, Insecticides India trailing at what, 14 PE appears compelling if you compare it with their peers, that is the Dhanuka Agritech and Sharda Cropcom. Now, if you see, I would say a recovery is expected. Now, this is on the back of ramp up of new production and also increased share of high margin products, which will eventually lead to higher EBITDA margin and of course higher profitability, and also the acquisition that the company has done will impact their profitability in a positive way. So overall, if you see valuation at 14 times doesn't seem a kind of a premium valuation, but you have to consider three things, while evaluating this company. One is the higher exposure to premium products would actually should lead to, higher margins, and how the capacities expansion will play out for the company, what would be the capacity utilization that the company is targeting into, and of course the new products that the company is expecting. I think 10 new products is expected in FY25. So all these factors will actually lead to valuation re-rating, considering the demand, the positive demand that all the agrochemical companies are expecting.
Yeah, a possible valuation re-rating, Varsha. I'll just caveat it at that, but a 30% discount is significant. I take your point on that. Let's look at what the outlook looks like, and Varsha, please chip in, because you know this maybe better than I do. Let's talk about premiumization strategy. There's a premiumization strategy which is in place. It's going to contribute around 65%. Premium product is going to contribute roughly 65% in the next 1 to 2 years, which is currently at 59. It's better margins. They're going to grow premium products at around 20%, which is very, very healthy. You have new launches in the pipeline, and you have an aspirational EBITDA margin of 12 to 13%. Now, help us dissect this. Is this realistic? What are the risks looking like to this commentary?
So, on that margins front, so when I look at the trend, Harsh, when you are increasing your premium products, there has to be increase in the margins, which the company has not seen. But
and the B2B to B2C shift as well.
Exactly.
Those two things.
Those two things. But I would give a benefit of doubt, considering the pressure that the company has been going through. But one thing is that if premium products are increasing, your margins have to improve. Number two is, the launches that a company is going into. We need to see, because 10 launches were expected in FY25. We are in the last quarter. Hopefully that those 10 products would have been launched. And the third thing is, the acquisition that they did will actually impact their profitability in a in a positive way, and that's one of the reasons why company is expecting double-digit growth, rather double-digit EBITDA margin. But the key risk that any agrochemical company faces is, one is, of course, poor demand and the delayed product launches that the company may see, and volatility in input costs will actually impact company, which they've seen the impact. And lastly, the pesticides ban, if government can consider, which may impact the company in the future. So these are the three main risks that the company may go through.
Perfect. Point taken. Let's quickly go across, before we go to management, look at what our KYC rating indicates with regard to this one. That's how we stack up in terms of our first 4 metrics, the next 4 as well. There you go. Those are our next 4 metrics, and therefore we stack up on as a 5 on 8 with regard to our KYC rating for an Insecticides India. Let's go across to management. Let's speak with Rajesh Agarwal, Managing Director at Insecticides India. Sir, a lot of our analysis also has hinged on the fact that there's been plenty of headwind for the industry as a whole. Talk to us about the unwind of that headwind, because we are seeing that as it plays out. How quickly can that happen, and how should your numbers therefore appear in FY26 from a growth perspective, purely from a top line perspective?
Okay. I would say that a big change has come in these past 2 years, because after the COVID had gone, the prices of all chemicals had declined, and we had to face that impact. And we are out of that impact fully in FY24 itself. And 25, you'll see the improvements. I cannot declare the numbers because the results are yet to come. But I'll say that we'll have the all-time highest profitability in FY25. And this thing is going to continue in FY26. In terms of the top line growth, yes, we will be targeting a good top line growth in FY26, roughly about 15%. And majorly this entire top line growth, the target will be to bring it from the premium products itself. So that is the focus as a strategy. And I believe that the response which is looking for the season, the response which is looking for the products, what we have launched in the previous last few years is very good. And looking at that complete situation, I believe that we should be able to do this.
Right. So, Varsha here, very good to have you. So as I understand, so the next leg of growth for Insecticide India is, premiumization, which you are expecting 20% growth also. Just wanted to have an update on it, because over the years, you have been seeing the contribution of premium products going up, but that is actually not coming into your EBITDA margin. So just wanted to understand, with this 20% growth and with the contribution that you want to take your premium products to, what kind of EBITDA margins are you expecting, maybe in next 2 years?
We'll keep on moving up step by step. I don't want to give very hefty numbers, but I'll say that we'll make a full recovery. In 25, we will be happy with our results. In FY 26, it will be evident from the first quarter itself, and all our quarters will show good performance. I am confident, and we can say that 10 to 15% type of growth will keep on coming in the next 2 years. So we can say roughly about 1.5% type of growth is possible actually in this FY 26, and should be possible in the next year also.
Got it. And also one more question from my side. Considering your export business, I guess it's 8 to 9% export contributes to your overall business. Now, where you want to take this contribution to, will you have a double-digit growth when it comes to export business in 26 and 27?
Yes, that will be, because we are working with many companies. We have started bagging some registrations. Very recently, we have bagged some registration in South America, and the business is going to start. So that will take us to the next level. And we are also having some like transactions are on, discussions are on with a lot of Japanese companies also. I see a breakthrough from there also. So I see a good outlook. This year, we'll be keeping our high growth targets for the export business. We wish, like we have been doing about 100 crore plus of export business. So this year, we wish to take it to about 200 crores.
Understood. Mr. Agarwal, you seem to be suggesting that Q1 of FY26 onwards, margins will take a sharper rebound. What are the levers that are giving you that comfort that margins will rebound? What has changed between FY25 and FY26?
We had launched a lot of products and we have got very good response. Most of these products are herbicides, particularly the maize herbicide, the rice herbicides, and we have got herbicides for almost every crop, and we are the brand leaders, even in soybean, in pulses, in sugarcane, we have got good solutions. In wheat, we have launched solutions. So we are backward integrating, making the AIs by ourselves, launching the brands, and also we have launched certain mixtures, which are the patented mixture. So that is giving us the edge. And very shortly, we are going to launch one product of Nissan also, which is going to be a rice herbicide. So that is also going to give us an edge. And in the previous year also, we have launched one rice herbicide, which is a mixture, patented mixture, which has already gone to the market. So looking at our premium products, I'm very, very confident that we'll start getting the sales from Q1 itself. And this is going to remain throughout the year, because Q1, Q2, Q3, we have products for all. And we should get very good response from the market. That is my assumption.
Understood. So how should we look at the journey here, sir? You'll grow roughly 20% in terms of your premium segment, right? That will grow at roughly 20%. Top line is your guidance. You'll go towards a double-digit kind of margin in FY26 and thereafter move towards 12 to 13%. Where will premium products be in terms of the overall mix, therefore? And how much does premium and B2C contribute? What are the margins like on those products versus the others?
Like the premium products are the ones which are giving good margins. Roughly, if I talk about the gross margin, not on EBITDA level, that will be about 35%. And B2C can go up to 75, I will say, in totality, because what you were showing on the in the graph was 1 quarter figure. So generally, the B2C sale, B2B sale is also strong in Q1 and Q2 and Q4. Q3 is subdued quarter actually. So in totality, we see the B2B contribution would be something around 25%. 75 or 70% will be coming from B2C, and export will be contributing somewhere about 6, 7, 8% actually. So this will be the tentative percentage.
Understood. Also, you have one automated plant which is coming up in Rajasthan, which you have done a significant investment there. Just wanted to know what are the timelines of the completion and how this will impact your top lines, and when can you see the financials coming in from this plant?
The target here, it's a place called Behror. The specific place is Sotanala Industrial Area. Here we have taken over a 15-acre site. The plant is under construction. The target is that we wish to start the formulation in this plant in April 26, and in next 2-3 months, in the Kharif season itself, we wish to start with the technicals also. Yes, this will be DCS plant, and we are working on this, and I'm quite confident that we should be able to complete this project within 1 year.
So one last question on how should we look at this. So around a 15% top line growth with roughly a 10% kind of margin would lead you to around 200 to 300 crore of EBITDA over the next couple of years, 250 to 300 if I were to be more specific. And thereafter, if I cut out depreciation and taxes, that will leave you with a PAT of roughly 150 crore. Is that the right way to look at the journey, or maybe over the next year or two in the near term?
I don't have the results, but that will be my target for FY25, not 26. So 26 will surprise you with our results, and the results will be evident from Q1 itself.
Okay, noted, sir. Thank you so much. It's been a pleasure speaking with you, and great getting that context from you with regard to Insecticides India. But you know, on that note, from Varsha, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.